funsupermart.com.
Hi everyone. With us today is Michael, the Managing Director at PineBridge Investments, and he is going to share with us his view on the U.S. equity markets. Hello Michael. What is your view on the role of the U.S. recovery, which seemed to remain bumpy over the past years?
Bumpy it's been, yes, but we actually think it will smooth out now. So the important thing is that there are two big drivers looking ahead, so two pluses and one minus. The housing recovery is starting to take place. Every U.S. recovery has been propelled by housing except for this one. This is just turning on, so that's a key source of strength for several years. The other is that for the last 20 years, the United States has lost energy competitiveness, but now there's this new phenomenon of shale gas, which is going to lower the cost of energy inside the United States and help the manufacturing competitiveness. So those are two pluses. One minus is that we've had fiscal help. We've been able to spend our way into growth, and we're going to begin to lose that next year for the next several years. So 2 steps forward, 1 step back, but it's still a pretty good story.
The Fed had announced a QE3 in mid-September. So what are the implications for the U.S. equity investors?
Well, you asked it the right way. The implications for the economy are not clear. That many of us believe that we're in a liquidity trap, and all this liquidity is not really getting into the economy or helping very much. But if it cannot go into the economy, it has to go somewhere. And that somewhere is normally the markets. And so it's actually very good. It can't last forever, but while it's here, it's going to make things much better for the markets than you would think by looking at the fundamentals. That's really been the story for the last year or so, and that story will become even more pronounced next year.
Do you see any impacts that the coming presidential election may have to the U.S. economy?
I think if you look to the end of next year, from now to the end of 2013, you won't be able to tell, because the markets are always about the fundamentals on one hand and the liquidity picture and the PE you put on the fundamentals on the other. And what we just said is that while over time these two forces are balanced, at any one time they can be very imbalanced. For the last 18 months, the fundamentals haven't mattered very much. It's all been liquidity. So maybe the presidential election can influence the fundamentals. Maybe it can't. But what will drive the market next year will be the liquidity, which is the same picture irrespective of who is elected. So, of course, from now to year end, it's viewed that if Obama wins, a fiscal cliff is more likely. The markets will be weaker. But we'll get over that very quickly. So it could influence the next couple of months, will not influence the next year.
As the S&P 500 index is inching closer to the historical highs, why are the U.S. stocks still worth investing?
Well, the price is back, but the earnings are significantly higher than they were last time the index reached this level. So to catch up to the earnings, it still needs to go up quite a bit.
How much upside should investors expect from the U.S. investments by end 2013?
Mid-teens, I think, would be another. Again, we need to get back. The earnings are at least 30% higher than they were last time the price was this high. And the price could grow into half of that next year and half of it the year after.
Given a 3-year investment horizon, what are the growth drivers for the U.S. economy, and what are the key risks?
Okay, so the growth drivers are still the same. The housing recovery is very, very early. That propels a huge number of jobs in the United States that will last for many years to come. The structure of most economies, if you move from an energy importer to an energy exporter and rejuvenate your cost competitiveness, that's a huge driver. So we're going to be with those for a while. And it's the same story for the economy of the markets. 2 steps forward, 1 step back. The policy will hold back the economy, but not entirely. It's still a net positive story for 3 years.